So what is technical analysis? As John McGee writes in his famous book, Technical Analysis of Stock Trends, he quotes, "It is the science of recording, usually in graphic form, the actual history of trading, and using that to deduce the probable future trend." A technician, as most of you might know, is different to a fundamentalist, in the sense that we solely look for value through charts, while a fundamentalist looks for value through a company's profitability, revenue, competition, products, and so on. Now that we got that away, let's look at what moving averages I use when analyzing charts. I know some of you might be confused as to why I use both the exponential moving average and the simple moving average. It's pretty simple. I use the exponential moving average for longer term charts such as the daily and weekly, to make sure I don't get potential signals late. On the other hand, I use the simple for intraday charts in order to filter out false readings. Volatility is high on the intraday charts, so I believe the best way to filter out incorrect readings is to use the simple moving average, which is slow to react to prices. Now let's look at the advantages of using multiple timeframes before buying or selling a stock. The purpose of using at least 3 timeframes is to make sure that there's alignment. This helps us find the best trades out there, which will yield us the best returns. Now you must be thinking, what if they don't align? Well, then it's better to have more patience, and wait till prices in all 3 timeframes confirm the movement. So now we have got 3 timeframes to look at. What is the correct order of looking at them? Simply, start from the longest and work backwards. If you are a swing trader, start from the weekly or monthly, then shift to the daily and finally onto the intraday charts. On the other hand, if you are a day trader, start from the daily, shift to the 30 minutes or the hourly, and then finally, to decide an entry, look at the 5-minute or 1-minute chart. It's as simple as that. Now that we finally know the basics of chart reading, let's look at some examples. Let's first look at the monthly chart of Flex. As you can see, Flex has had a massive run on the monthly, which would have urged certain traders to buy it blindly, assuming that there's more potential for further upside. However, zooming out, you can see that prices are right at a 17-year resistance level. You would have not seen this on the daily or intraday charts because no one would have really bothered to look at prices from 17 years ago. Probably you spotted it. On the same chart we can see a 12-year trend line, which if prices fail to break above resistance, any pullback should find good support on the bullish trend line. None of these would have really been spotted if you just look at the daily or intraday charts. Now let's look at a weekly chart from Shaw Communications. Here we can see a 6-year-old bearish trend line, where again unless prices break the trend line, I would not go long. A lot of traders make the mistake of not waiting for prices to confirm the breakout. You can use shorter timeframes to possibly anticipate the breakout, if those charts show bullish signs, but if the pattern is on the weekly, never put all your money in, until prices confirm on that specific timeframe. Let's look at the daily from the same ticker to see how we can anticipate a possible breakout. We can see a bearish trend line on the daily as well, when and if prices break above that, you can possibly buy in anticipation of a break above the weekly trend line as well. However, as mentioned on the chart, never go all in. If you are buying in anticipation, buy on small size to mitigate risk, and add along as prices continue to confirm your analysis. Next, let's look at an interesting daily chart from People's United Financial. This is a good example of looking for possible occurrences in the price action. As you can see, People's United have a strong tendency to form shooting star candlesticks after rallying, which can signal a possible reversal. And as you can see, prices after breaking above the symmetrical triangle, formed another shooting star pattern. However, the question here is, will it have a strong correction? As of now, it's difficult to say, since prices did close above prior daily resistance. Therefore, this is a good point to wait for confirmation, rather than getting in, assuming prices should now find support at the broken resistance level. Let's finally look at the intraday charts. Here we will use the 30-minute time frame. A lot of people who analyze charts these days probably never use the 5-day moving average to confirm short-term price action. In my opinion, this is the best way to decide whether it's good to enter now or not. If we look at the 30-minute chart of Flex, you can see that prices are above a rising 5-day moving average. Now, why do I call it a rising 5-day moving average? Please note that it is important to see the slope of the moving average rather than just seeing if prices are above or below it. For example, if prices are below a moving average, it doesn't necessarily mean it's a red flag unless the slope is negative. We will look at a few examples at the end. Back to our example of Flex, we can see several topping tails showing that prices are having a hard time getting above the broken support level. So does that mean the 5-day moving average will be broken? Well, for now the slope is up, so continue to expect short-term prices to favor the upside. However, if we consider the monthly and daily chart of Flex, you would probably be better off staying on the sidelines until prices break the resistance level. So now you can see how analyzing on multiple time frames help you refrain from getting in on wrong places. Now let's look at Genius Brands and CIDM, to show why it's important to notice the slope of the moving average. As you can see, prices on both charts failed the first time it pushed above the 5-day moving average, since the slope was bearish. However, as soon as the slope started to flatten out, prices broke and found support at the moving average and thereafter continued higher. So, there you go, I have given you the best way to analyze charts and refrain from putting your money in stocks that won't yield you any sort of returns. If you find this video helpful, please like and subscribe. Also feel free to post your thoughts on the comment section below.